Hi, good evening, participants. My name is Colleen, and on behalf of CGS-CIMB Securities Singapore, thank you for joining us today. We are here today to gain insights on the market development in China and also to uncover the investment opportunities that lies within it. During the session, if you have any questions, do not hesitate to raise them in the Q&A function that you see on your Zoom platform. And we will do our best to answer most, if not all, of the questions after the speaker has finished his presentation. For tonight's webinar, we will begin with an introduction to the China A-shares market, followed by a discussion on the market outlook and preferred stocks and sectors. Presented by Mr. Wong Chi-man, Head of Research at China Galaxy International. Then we will end off the session with Q&A. A little background of the speaker tonight, Mr. Wong. He has a wealth of experience in the equity research arena, having worked in both Chinese and foreign investment banks and securities firms. His research coverage spanned across various sectors like industrial, telecoms, utilities, just to name a few. With his extensive knowledge base, together, we will uncover the investment opportunities in the A-shares market in tonight's webinar. Without further ado, I will hand the time over to Mr. Wong. Mr. Wong, please.
Thank you, Colleen. Good night. Good evening, and I'm Wong Chi-man, Head of Research of China Galaxy International. And it's my pleasure to have this opportunity to have this webinar with you. And I will take this opportunity to give you an introduction about the China Asia market. And after that, we will also talk about the general market outlook and also discuss about our preferred stocks and sectors. So let's start now. Okay. The presentation will be divided in 4 parts. First of all, I will give you a general overview of the China Asia market. And then we will also try to tell you some major differences between the China Asia market and the Hong Kong market. And then we will also talk about the valuation of the Asia market and compare it with international markets. And finally, we will go through the market outlook and also some of the sectors or stocks we believe you may pay attention. So let's start. So first of all, what we are trying to do is give you some general idea why you should spend some time to look at the Asia market. And we will try to look at the scale of the market, the number of companies, and also the trading volume. First of all, as you can see on the left-hand side of the slide, in terms of market cap, the top 10 in the world, you can see both Shenzhen and Shanghai. They are in the top 10 in terms of market cap in the world. And if you look at the right-hand side, if we combine the Shanghai and Shenzhen market together, you can see actually it is the second largest stock market in the world just after the US, as you can see the largest one, NYSE and also NASDAQ. And actually that means in the Asia Pacific region, it is the largest equity market in the world. And if we look at the number of companies, as you can see here, also the left-hand side is top 10. You can see both Shanghai and Shenzhen, they are in the top 10. And if we combine them together, we are talking about nearly 3,900 companies. So basically, it's also the largest one in Asia Pacific region. And globally, you can see if you combine NASDAQ and NYSE together, US are still the largest. But that means if you look at the Asia market, it gives you much more choices. And even though probably right now overseas investors cannot invest in all these 3,900, you can only invest in through the Stock Connect program. But even the Stock Connect program actually currently provide you about 1,400 companies, still a very large number of choices. So that's why we believe this is another reason why you should look at the Asia market, because it gives you a wider range of choices for investment opportunities. And then another thing we would like to highlight about the China-Asia market is about the trading volume. As you can see, the left-hand side, once again, is the second largest in the world in terms of trading volume, just after the United States. And another thing is probably is also a uniqueness of the Asia market is the relatively high trading velocity. What is the meaning of trading velocity? Basically, it is an indicator telling you the frequency of the stock changing hands. So that means if the number is higher, that means the frequency is also higher. This is the reason. The reason is because the retail investors, they play quite a big role in the trading volume in the Asia market, and then the trading velocity is also higher. So the good thing is that means when you want to buy or sell a stock, usually you don't need to wait for a long time. Probably just in a short period of time, your order will be completed. But maybe some of the potential risk is because of this higher trading volume, that may also imply some small and mid caps, the share price volatility may be higher. So, so for some investors, they may need to pay attention to this. And then if we go to the next part, talking about the market segmentation of the Asia market, because I think some of the investors here, they may have experience in investing in Hong Kong market, but the Hong Kong market is quite simple, only a very large main board and then a very small gem board. But in China market, we see more segmentation. First of all, it is divided into two parts. One is Shanghai and the other one is Shenzhen. For Shanghai, actually, we have nearly, as you can see here, nearly 1,700 listed companies, and the scale is really big. We are talking about 42 trillion renminbi. And we have two major segments in the Shanghai market. One is the main board, and the ticker start with 60. Actually, why it is important to look at the ticker? Because it tells you some idea about the risk profile of the companies. Because after that, we will talk about the star market, which has a higher risk profile. And so right now for the main board, we have nearly 1,600 companies, and the market cap is talking about 40 trillion, very big. So this is more for those maybe more so-called traditional companies. That means usually the listing requirement will be higher. For example, higher standard of profit track record requirement, and also the revenue track record requirement will also be higher. But as you can see, we also have the so-called star market, starting with the ticker 688. Because it is a new board starting from last year, so the number of companies still very small, talking about 120, and the market cap about 2.3 trillion. And as you can see here, the purpose is more for those companies with shorter operating history, but maybe have a very high growth potential, like maybe in technology, maybe in biotech. So that also means the risk may be higher because of shorter operating track record. Some of them may be only a small profit or maybe still loss making. So the risk may be higher, but it also gives you maybe more upside, depends on your risk profile or risk appetite. So we go to the Shenzhen market right now. For the Shenzhen market, we have more than 2,200 companies, and the total market cap also quite big, talking about more than 30 trillion renminbi. And in terms of the segmentation, we have three segments. One is the main board, start with 00 for the ticker. And we have 470 listed companies and talking about 9 trillion market cap. The role of this main board is more or less similar to the Shanghai main board. So also more for those mature sectors or mature companies. And we have higher standard of listing history, higher standard of profit requirement and revenue requirement. And we have another two boards maybe the risk profile may be relatively higher. One is the SME board, ticker start with 002, and we have about maybe nearly 1,000 companies and market cap 13 trillion renminbi. So as you can see from the name, SME means small and medium-sized enterprises. So it's more for some small and mid-cap companies. And the listing requirement, that means the profit requirement, revenue requirement may be lower. And we have also a CHIN export, and the ticker start with 300. We have 800 companies there, and market cap nearly 9 trillion renminbi. Actually, the role may be a bit similar to what we just mentioned, the so-called star market in Shanghai. That means more for those high growth companies, technology companies, but probably the listing, the so-called operating history may be shorter, and maybe some of them, the profit may be still at a very low level. So that's why the risk may also be higher. So just a recap for the main board, maybe more for the mature companies. Relatively speaking, the risk may be a bit lower. But for the star market, SME board, or CHIN export, they give you maybe higher growth potential, but at the same time, because of shorter track record, the risk may also be higher. So you need to make your judgment based on your risk profile. And then we try to compare the Asia market with the Hong Kong market, especially in the past for many investors, when they think about investment in China, look at the China growth story, many people will look at the Hong Kong market first. But why you should also look at the Asia market? Actually, you can see here, the left-hand side. For the financials, you can see this is the breakdown of Hang Seng Index. Actually, more than half from financials, because of some historical reasons, because maybe more than 15 years ago, we see a lot of major Chinese banks listed in Hong Kong first, and then go back to the Asia market. And that's why you can see the financials accounted by nearly, or actually more than half of the total market cap. But if you look at the MSCI A Inclusion Index in terms of market cap breakdown, you can see a more balanced. Financial sector is still very big, but we are only talking about maybe about 1/4. But for other high growth sectors, we also see a meaningful contribution. You can see for IT, we have about 14%. And for healthcare, we also have nearly 11%. And also for consumption place, we also have a meaningful contribution here. So that's why if you look at the Asia market, it may provide you some very different choices, maybe not available in Hong Kong. For example, the most famous one, some people may also know, is the Guizhou Maotai, the very famous white wine company. And also a very famous home appliance company, Midea, also listed in the Asia market, but not in the Hong Kong market. So that's why looking at the Asia market actually may broaden your investment horizon. And another major differences between the two markets is the investor breakdown. As you can see on the left-hand side, if you include the local retail investors and overseas local investors, we are only talking about less than 20% of the trading volume from individual investors. We have more than 80% from the professional or institutional investors. But if you look at the right-hand side for the Shanghai market, you can see because of the much shorter history compared with the Hong Kong market, you can see actually a large portion, more than 80%, still from the trading volume, still from individual investors, and less than 20% from professional and institutional investors. So that means the share price volatility may be higher in the Asia market because it is still more retail driven, unlike the situation in Hong Kong, because it is a very mature market. So the trading volume basically is driven by institutional investors. So right now we go to the next part. We try to give you some idea about the valuation of the Asia market and try to give you some idea, compare with the US and Europe, whether it is expensive or not. As you can see, we highlighted CSI 300 here, which is one of the major benchmark indices for the Asia market. You can see actually the performance year to date, the right-hand side, actually property is one of the best in the world year to date. You can see the performance is more than 15%. You can see in overseas market, especially in Europe, still negative year to date. And even for S&P, still negative. But for NASDAQ, we see quite good performance. And in terms of valuation, as you can see for the PE, we are talking about something like 15 or 14 times. Actually, when you compare with, as you can clearly see here, if we look at the US market, we are talking about mid-20s. And if we look at the European market, we are also talking about nearly 20. So from this perspective, probably the Asia market is still not very expensive. And if we shift our focus to the Asia Pacific region, you can see in the Asia Pacific region, the China-Asia market is still one of the best performance year to date, because you can see like Japan, like Hong Kong or Taiwan, some of the markets, actually you can still see maybe negative or only a very small positive. And if you compare with Shanghai and Shenzhen, I would like to highlight here. As you can see, the Shanghai market, the valuation is lower. But for the Shenzhen market, the valuation may be higher at around 25 times PE. The reason is for Shenzhen market, if you still remember, we have the SME board, we have the Chinex board. So actually, we have more small mid caps or more high growth companies. That explain why in the Shenzhen market we see a higher valuation. So it does not necessarily mean it is more expensive, but maybe reflecting the companies there, many of them may have higher growth potential. So right now, we go to the next part is to give you some idea about the latest economic situation in China, especially after the COVID-19. Many investors want to know about the progress of recovery. And you can see on the left-hand side, which is the coal consumption by the major power plants in China. You can see in late January and February, the coal consumption dropped quite a lot because of the lockdown of many cities. But you can see starting from March, we see a gradual recovery of coal consumption right now, more or less maybe back to 80 or 90 something %. So we can say, especially for the manufacturing or construction sectors, the recovery, I think more or less is quite on track. And if you look at the right-hand side, the retail sales, you can see in February, it dropped quite a lot, down 20% year on year. But you can see right now already recover quite nicely, only single-digit decline year on year. But for some sectors, I would like to highlight maybe still quite challenging in the near term for the services sector like tourism, aviation, catering, because for all these industries, we still need to maintain some social distancing measures. For example, for tourism, right now China still shut down some of the theme parks, or even some theme parks reopen, they will limit the capacity, maybe 50% or only 60%. Similar for aviation, we may not be able to allow the capacity at 100% utilization. So, for example, last month in June, the passenger for the air traffic may be down about 40 or 50% year on year. So it still takes some time to fully recover for some of the services sector. But for manufacturing or construction, I think it's recovering quite nicely. And then the next page, right now we are looking at the fiscal and monetary policy in China. The left-hand side we are trying to show you is the inflation rate in China. You can see in the earlier time, actually we see some pressure on inflation, mainly because of the pork prices in China increasing quite rapidly. But the good news is in the past few months, we see a slowdown in the pricing pressure of pork prices. So the moderation of pork prices also help the inflation pressure to come down. And therefore, that means right now, at least for the central bank in China, they have more room to have monetary policy support because they don't need to have too much concerns about inflation. And in fact, if you look at the right-hand side, the M2 growth, you can see in the last few months, in particular, in order to support the economy, you can see the M2 growth accelerated in the last few months. And another thing is about the fiscal policy, because in May, when central government announced the full year budget, they set the budget deficit target as about 3.6% of GDP, only more or less in line with the market expectation. At that time, it's about 3.5% for market expectation. So that means in second half, if let's say for whatever reason, the government need to provide extra support to protect the downside of the economy, actually the central government still have some room to do so. So that means for both monetary and fiscal policy in the second half, in case we need further support, the Chinese government actually still have some room to do so. This will provide some downside support to the market. And the next part, we would like to talk about the renminbi exchange rate, especially for investors outside China. This is quite important because if you earn money from the indices, but because of the exchange loss, you cannot make money, then it's also not very good. So it's important to look at the exchange rate. Actually, if you look at the left-hand side, we are looking at the US dollar exchange rates. You can see in early this year, especially because of COVID-19, people are conservative and they shift the money to US dollar. And that's why we see the US dollar exchange rate quite strong. But very recently, we see some decline because especially in the Asia Pacific region, we see the situation more or less recovering, especially in China. So some people shift money out from US dollar and we see some weakness. Actually, this is a positive for renminbi. The right-hand side is the renminbi exchange rate versus the US dollar. As you can see, actually, in early this year, especially because of the lockdown of the Wuhan city, you can see there was some pressure on renminbi. But right now, you can see in the last 1 or 2 months, we see the rebound of renminbi exchange rate. And if you look at from a longer term horizon, starting from second half of last year, basically right now renminbi is only within a range. So that means at least in the near term, it seems that the exchange rate risk of renminbi for overseas investors should be manageable, given that maybe only ups and downs within a narrow range. And then right now we would try to look at the valuation of the Asia market, compare with the historical valuation in the past 5 years. You can see right now the latest rolling forward PE for the Asia market. If we use the CSI 300 as the benchmark, we are talking about 14.6 times. As you can see right now, we are near the high end of the historical range, in particular because of the market rally in the past two weeks. So I think people may have concerns whether it is expensive or not. Put it this way, I think for some new investors, if you want to wait and see for a while, I think it's okay. But if we are talking about whether it is very expensive, I think not, for 2 reasons. One is we need to also look at the interest rate, because right now we know that globally, not just in China, not just in the US, but also in other parts of the world, we know that the global interest rate generally are coming down. So that means actually we can accept a higher PE because of the lower interest rate, because a few years ago, the interest rate clearly was much higher. So this is the one thing. The other thing is actually we just show you a table. If you compare the China market with the US or Europe, probably right now is still not expensive. So I will say if you have limited experience in the Asia market, you want to wait for a while, I think it's okay. But if you're talking about whether right now it's very expensive, I think not, because of the very low interest rate. And also when you compare with the international market, also not expensive. But for subsegment, I agree you need to be more careful for the Chin export in Shenzhen. Right now, the latest rolling forward PE is about 48 times, and the 5-year average is 29. So I will say whether you look at the absolute level, 48 times, and when you compare with the historical average, talking about 29 times, I will say maybe for new investors or investors with limited experience in the China-Asia market, maybe better to be more cautious for this Chin export because maybe the risk may be relatively high at the moment, given the valuation from absolute level or relative to historical level also quite high. So right now, we maybe come to the conclusion about our preferred sectors and also some of the stocks we believe you may pay attention to. First of all, I would like to highlight some of the risk factors first. Actually, I think in the second half, the most uncertain factors is still the United States because of the president election in November. So whether we will see more actions against China, we still need to wait and see for a trade war or some other things. The other major risk, I think all of us know, is whether maybe in autumn or in winter, we will see another more larger scale outbreak of COVID-19. But we need to wait and see. So based on these two major risk factors, that's why we would more prefer sectors focusing on the domestic China business rather than have a lot of external exposure or export exposure because we don't know whether we will have another trade war or some other things which is out of control of China. And so therefore, from a longer term perspective, we still like healthcare and technology sectors, especially for healthcare sector. I think the reason to invest is quite straightforward, given that, in China, because of the long history of one-child policy, although they relaxed a few years ago, but because they implemented this policy for quite a long time, in the next few years, clearly we will see the aging problem in China. Definitely, it will drive the demand for healthcare. So we believe for this sector, it is a multi-year growth story. And for technology, I don't think I need to explain. I think many people know especially for the internet development in China. Some of you know the WeChat and some other things. So I don't think I need to elaborate more here. But I agree, maybe in the last few weeks, these two sectors, actually not just a few weeks, but for the first half, up quite a lot. So I think you may wait for a while to see whether there is a better entry point. But in the near term, I think you may also look at food and beverage, construction materials, and financials, given that their valuation right now is still not very demanding, especially for financials. And so you can see at the bottom of the slide, you can see a table there. Some of the stocks, our headquarters in Beijing, China Galaxy Securities, think that you may have a look for this month. And maybe I highlight some of few for your reference. I think the second last, I think most people know it, the Guizhou Maotai. Definitely, it is a blue chip. And I think in particular for new investors, you may pay more attention given that they have a unique brand and very good earnings track record. So I think the risk may be more manageable. I'm not saying that no risk, but at least the risk should be more manageable for new investors in the Asia market. And I think another stocks, if you think that the bull market in the Asia market will continue for a while, then I think you may also look at China Merchant Securities, which is one of the major securities company in China. And then maybe if you can accept a higher risk profile, then I think this CATL 300750, you should pay attention because it is the largest electric vehicle battery producer in China. Actually, right now they are supplying battery to Tesla. And a few days ago, Honda also invested 1% stake in this company. So we should expect Honda will also have more cooperation with CATL. So I think you may have a look if you can accept high risk, because you can see the PE definitely is higher because it is a high growth sector. And another company I think you may also look at is Myray, because actually right now it is a medical equipment company. And right now, based on our research, around 40% of their product actually is related to COVID-19. And that's why actually their first half profit performed quite well because of the stronger demand for their equipment. So I think you may also have a look, but as I just mentioned, because the ticker start with 300, the risk profile may be higher, and PE right now about 62 times and 51 times next year. So maybe more suitable for investors who can accept a high risk. And finally, to wrap up, maybe I would like to highlight some key points for new investors in the Asia market. First of all, I mentioned several times, pay attention to the tickers and try to get some idea whether it is from the main board or from Chinix or from Star Market or from Chinix. Then at least you have some rough idea whether the risk is high or not. Although I'm not saying that it is an absolute indicator, but at least it can give you some rough idea. And the second thing is this market is still very retail driven, as we explained, maybe 80% volume from retail investors or individual investors. So the share price volatility for some small and mid caps may be quite high. So you need to have better risk management. And then the third thing is very different from the Hong Kong market, because in Hong Kong market, usually we don't have the so-called daily share price volatility limitation. But in China, some of them, the ups and downs may be just within 10% a day. For some stocks, maybe 20% ups or downs. So you may also need to pay attention to this point. And finally, I think some people know that is for Asia market, you cannot day trade. That means you cannot buy and then sell on the same day. So for some short-term investors or frequent traders, they may need to pay attention to this arrangement. So maybe I just stop here, and then I will let Colleen talk about some promotions, and then we will come back to the Q&A session. Thank you very much.
Thank you, Mr. Wong, for the valuable insights of China A-shares. Before we proceed to the Q&A section, I would like to share a piece of good news for clients who has a trading account with us in Singapore. We're extending the promotion that you see on screen for clients who trade in the China A-shares. You will continue to enjoy a discounted brokerage rate of 0.15% when you execute trade online. It is also noted that some of the investors joining us in this webinar could be from Malaysia and holding a Malaysia trading account. In this regard, you may have to check with your trading representative in Malaysia separately. All right, and in addition to that, right, just to let the participants know that we also offer a very comprehensive research materials on our platform. You basically can download the research materials from the online trading platform. All you need to do is to log into your account, go to the research tab, and download whichever reports that you need to. Basically, our research reports cover globally. All right, so now with that, we will proceed to the Q&A section. Yeah, so Mr. Wong, the first question that we have tonight is from Xia. So his question is, how much is higher trading volumes related to algorithms, basically in comparison to algorithms?
Probably, I don't think right now for this part is compared with the US. US, we know that for algo trade, probably a very high portion. For China, I don't have official statistics, but my gut feeling is probably it should still be much lower than the portion compared with the US. The reason is probably you may pay, I think you may notice that I just explained in China right now, in most cases, day trade is not allowed. That means you cannot buy and sell on the same day. That creates a lot of limitations. So my gut feeling is for algo trade, very likely should not be as active when compared with the US.
Okay. Thank you, Mr. Wong. Okay, the next question that we have also from Xia. He asks, with the recent Luckin Coffee accounting fraud, right? How can we trust the Chinese companies? And also, how can we avoid this?
I agree, given the history of the Asia market, is still quite short, but because both Shanghai and Shenzhen, we are talking about starting from early 1990s. So compared with Singapore, Hong Kong, or Japan, the history is quite short. And therefore, I think it's maybe inevitable. We may see the corporate governance and some other issues may not be able to compare with some developed markets at the moment. And I cannot say we have so-called maybe some absolute rules to help you screen the companies, but I may provide some idea. At least you can reduce the risk. For example, because right now, based on our research last year, we noticed that maybe right now, maybe still a relatively low portion. I forgot the exact number, but maybe 30 to 40% of the companies in Asia market they are audited by Big Four. That means maybe around 60 or 70% of companies still not audited by Big Four. This ratio is much higher in Hong Kong. Hong Kong actually a very large portion audited by Big Four. And so I think this may also give you some idea about the quality of the accounts. This is one thing. The other thing, as I just mentioned, you may also look at the tickers because it gives you some rough idea whether it is from some mature sectors or from some high growth sectors. Because some high growth sectors, that may also mean the potential risk in different areas will be higher. Because, for example, maybe the operating track record may be shorter. So that means it's maybe more difficult for you to find out some of the accounting problems because you have only limited years of account for you to check. So that may be some of the idea I can give you to have maybe some screening about the quality of the companies.
Sure, thank you. Okay, the next question that we have here is, why is there a star and the Chinex? Chinex is already existed, and why is there still a need to set up the star? And the follow-up question is, why do companies choose to list in one but not the other?
Actually, there are some historical reasons there because the Chinex, the history is much longer. But actually, right now, for Shenzhen Stock Exchange and Shanghai Stock Exchange, actually they have some internal competition. So that's why when Shanghai found that a lot of high growth companies went to the Shenzhen Stock Exchange, the Shanghai Stock Exchange also want to set up a new board for high growth companies to compete with Shenzhen. And so that's why I think for those companies, I think they will look at whether Shenzhen or Shanghai is more friendly, and then they will choose the listing destination, whether they will try to list on the Star Market or Chinix. Actually, there may be also some minor differences because I think Chinix may also revise the rules very soon. But right now for Star Market, one of the uniqueness is they allow those so-called weighted voting rights company to be listed there. That means I think Alibaba, maybe JD, some of these companies. Right now, actually, they have two different groups of shares, Class A and Class B. And I think you may know that the Class A voting right is higher than the Class B voting right. For these kind of companies, in the past, they cannot go back to the Asia market. But right now, if they want to, they can go to the Star Market. So that also may be something different between the two at the moment.
Sure. Okay, the next question that we have here is, what is the difference between China A shares and B shares?
For B shares, actually also very long history, but the trading currency is different. For Asia market, the trading currency obviously is renminbi, but for Shanghai B, the trading currency is US dollar, and Shenzhen B, the trading currency is Hong Kong dollar. So you can see actually the original purpose for B share market is for foreign investors, but unfortunately, the development is not very good. And that's why right now the B share market is a very, very small market. And if I remember correctly, more than 10 years, we don't have new IPOs in the B share market. So it's a very small market. And so if you really want to find investment opportunities, most people will go to the Asia market. Given that the B share market right now is very small, the trading volume may be also quite thin, so may be more suitable for some professional or institutional investors rather than for general investors.
Sure. Okay, the next question. What do you think about the current valuation for China tech stocks?
It depends, because as I just explained, in the Asia market, for example, in Shenzhen, we may have more high-tech companies there. We are talking about more than 2,200 companies in Shenzhen. So I cannot say very general, say whether it's expensive or not, but I agree. Some of the companies, because of the rally in the Asia market in first half of this year, right now the PE may look quite demanding. For example, I show you Chinix. The PE right now on average is 48 times. And the historical average in the past 5 years is 29 times. And that's why I think for some of these companies, if you look at the valuation, if you don't feel comfortable, then I think you may wait for a while rather than pushing yourself to buy. Because I think for the full year, usually you should have some entry point. You do not need to force you to buy at the moment, but you can closely monitor and find a good entry point.
Sure. Okay, we have one question from this participant. He asks, does it really matter which exchange, Shanghai or Shenzhen, a company is listed on? Because more importantly is about the company and the stock that the investors is interested in, right? And then followed by the brokers platform, rather than the which exchange. Well, what do you think?
I agree, because in both Shenzhen and Shanghai, we have some good companies. For example, in Shenzhen, we have some very well-known companies like, for example, Maotai and Media, and also some of the companies we just mentioned, like Myray, the the medical equipment companies. But at the same time, we also have some very large companies in Shanghai market. For example, the big four banks, all of them in Shanghai, and some of the very large insurance companies are also in Shanghai. And also because of the newly established stock market, we will also see more high growth companies in Shanghai. For example, a leading semiconductor company, SMIC, the IPO will start trading tomorrow. So I agree, you can find good companies actually in both Shanghai and Shenzhen.
Sure. Okay, next question is from Wei Jie. He says, with the current US-China trade war tension and the recent India-China border dispute, do you think this will limit the growth of Chinese companies?
I think that's why, as you can see from our presentation, because of this kind of uncertainty outside China, that's why we prefer those sectors focusing on domestic business. That means they will be less affected by those, for example, trade war and other sanctions. Because probably maybe after the election in November, we may have better visibility. But before that, probably maybe spend more time on those domestic companies rather than those very export-oriented.
Okay. Okay, this participants ask for stocks with dual listing like Alibaba listing in Hong Kong and US. What is your view pertaining to which exchange should the investor invest the share to buy the shares from?
Frankly speaking, I think not much difference because it's very different. I think some people may know that, for example, if a company is still listed in the Asia market and the Asia market, sometimes the price difference, we may be talking about 30% or even more, because there is no arbitrage mechanism between the Asia and Asia market. But for Hong Kong and the US, actually, there is an arbitrage mechanism. So usually the price difference may be within only a few percentage. Unlikely to see like Asia market, we are talking about the price gap is 30-40%, unlikely. So I don't think there will be much difference there, given that usually the price gap will be within a very narrow range.
Sure. Okay, we have one question from Jack. He asked, in the event that a vaccine is available, which sector or company, in your point of view, do you think that investors can look at?
It's difficult to tell at the moment because both in Hong Kong and China Asia market, some of the biotech companies claim that they are doing some R&D in vaccines, but frankly speaking, all of them right now still maybe still in the trial period. So we don't know which one will be successful or not. So we still need to wait and see, because right now I think there are really quite a number of companies saying that they are doing some R&D in vaccines, but up to this point, I really can't tell which one will be successful. So we can just wait and see at the moment, frankly speaking.
Sure. I would like to take this opportunity to highlight to the participants that this presentation there's no buy call or sell call. So basically, whatever is presented in the presentation earlier, right, is basically from Chiman's point of view, and all the investors are advised to do your own independent evaluation of the company, the stocks that you want to invest in. All right. So for the Q&A session, we won't be giving any recommendation or advice as to which stock that you should look at. So please take note of this. Okay, we will continue with the Q&A. The next question is, what is the impact of US ending the autonomy status of Hong Kong on the Chinese company?
Because right now, I think you are talking about the latest actions early this morning.
Yeah.
And the immediate impact, if you're talking about on corporate level, may be relatively limited because, for example, if we say right now for Hong Kong exports to the US may be subject to tariff, but because the situation actually changed quite a lot in the past 20 years. So right now, actually, direct export from Hong Kong to the US actually is only around 7% or 8% of the total exports in Hong Kong. So the so-called immediate impact more or less will be, but we don't see a very large impact given that the direct export from Hong Kong to the US is only about 7 to 8% of the total exports. But I think the issue is because right now they only announced a general directions early this morning. We need to wait and see whether there may be follow-up actions, because the direction this morning actually is open the door for some follow-up actions. So we will need to wait and see. But up to this point, I think just based on what we see, the impact is still limited at the moment.
Sure. Okay, next question is from Arthur. For foreigners buying into China A shares, all the settlement currency is in HKD or RMB?
If you go through the Stock Connect program, based on my understanding, you don't need to prepare renminbi because the stock exchange will handle this for you. So you don't need to exchange renminbi yourselves if you are trading under the Stock Connect program.
Sure. Okay, next question from Leong Man Wai. The question is, SMIC dropped more than 8% today just before it starts trading in the Shanghai tomorrow. How would you think the trading will be like in Hong Kong and Shanghai tomorrow? What other semiconductor company can you maybe point out? And what is your view on the auto sector? Yeah.
And I think for SMIC, maybe in the near term, I will say the share price may be quite volatile, especially because I think because of the expectation of the Asia IPO, the Hong Kong listed SMIC, the share price really went up quite a lot. And if you compare the latest valuation with the historical level, actually it is quite high. But does it mean that it will drop immediately? I can't say, because right now some people are speculating the government policy. I think if you ask this question, I think right now people are looking at whether if we have more US sanctions, whether this company will get more government support. So if the share price is driven by policy expectation rather than near-term earnings, it's difficult to tell whether we will see the peak at the moment or not. But what I can say is if you're looking at absolute valuation, right now already quite high, and you may need to be more careful. But for the Asia IPO tomorrow, I think at least at the beginning should perform well, given that right now, based on the IPO price in the Asia market, if I remember correctly, it should be lower than the Hong Kong listed price. So, but after that, we need to wait and see. But at least for the first day, because of the reason I just mentioned, I think the first day performance should be okay.
Sure. Okay, next question. In terms of dividends, how good are the dividends for A shares compared to Chinese companies listed on the Hong Kong exchange? Is there any difference? And also, do SOE, state-owned enterprise, generally declare better dividends? What other companies generally declare high dividends?
Unfortunately, generally, I'm not saying that the payout ratio is different, but because as you can see in some sectors, for example, we just mentioned like Chinix, the PE is 48 times. That means even at the same payout ratio, but because of the much higher share price, the dividend yield may be lower compared with the Hong Kong market, because Hong Kong market, generally speaking, the valuation is lower. But because, as I just explained, some stocks only available in China, for example, Maotai, Midea, Myray, the leading medical equipment producer we just mentioned, or CATL, the leading EV battery in China, also not available in Hong Kong. So I think if you invest in the Asia market, in many cases, you are not looking at dividend, but because they provide some very interesting growth opportunities, which may not be available in Hong Kong.
Sure. Okay, thank you everyone for sending in the questions. In the interest of time, we will just pick one more questions to answer from the list, right? Okay. For tech stocks, right? Is there any impact following the latest sanctions against Huawei?
Frankly speaking, because I think UK also just saying that they will gradually phase out Huawei equipment.
Right.
So the implication is, because right now that means many developed countries, the US and many European countries, they will not use, or they will try to minimize the use of Huawei equipment.
Sure.
The implication will be, because that means you need to look at other suppliers. So very likely, that means the global rollout of 5G network will be postponed, because you need to consider other suppliers. So there will be tendering, all this process. That means the global shipment of 5G handsets, the ramp up will be slower than expected, very likely because of this reason. So that means some handset or handset components companies, their earnings visibility in the near term will be more uncertain. That means the share price will be more volatile because of the slower rollout of 5G network outside China. And I think investors may need to pay attention to this if you own some handset or handset component stocks.
Sure. Okay, with that, we will end off the session for tonight, right? But last but not least, we would like to thank Mr. Wong for taking the time to speak with us this evening. We would also like to thank all the investors who have joined us in this webinar. We have prepared a short survey for your completion. It will definitely help us to improve our future webinars. You may scan the QR code on the screen to complete the survey. Once upon the completion of the survey, we will extend a copy of the presentation slides sent to you for your reference. If you have further questions, please do not hesitate to reach out to us via the email address that you see on the screen. We hope to have you again on our other webinar sometime in the near future. Once again, thank you everyone and enjoy your evening.